Good evening, ladies and gentlemen. Thank you very much for joining us. I am sure all of you are excited about the way these sessions are going. We're getting very positive feedback from our participants. And let me share with you that the number of participants is continuously growing. So we are, just by the popularity of these sessions, we are continuously getting requests from our membership in around 17 countries now. So very happy to hear that. But about 17 countries from where our members would want to join and listen to these sessions. In addition, even from outside our membership in Sri Lanka particularly, there are people who are interested in listening to Roshni and her team, who are doing a fantastic job in sharing the wealth of knowledge about Sri Lankan tax. So without any further ado, let me hand over to Roshni for an introduction of new team members today. First of all, we welcome both of you to the 60 Digits program. Thank you very much for taking time out. But before that, let me hand over to Roshni for introduction. So Roshni,
Thank you so much, Harun, for that kind introduction again. Welcome, everyone. So as Harun said, it's a continuation of our series on taxation landscape in Sri Lanka. So today's session is on transfer pricing from a local context. So today, to do the session, I have two staff members, Mr. Hasita Radalla, Senior Director Transfer Pricing, and Janindi Jayavira, Senior Manager Transfer Pricing. Just to give a brief on the transfer pricing service line, it's fairly new, probably about 5 to 6 years, and both of them had the privilege of setting it up from inception, so they have heaps of knowledge as to how the law has transitioned. And also Hasita has been with the firm for a very long time as well. So I'm not going to speak much. They will take this session forward. As in the past, please do ask questions. They'll be happy to answer. Thank you. Over to you, Janindri.
Thank you. Yes, so let's kick off the session straight away. So today's session is on transfer pricing, and today we will be discussing on 5 key areas. So first, we'll give a brief introduction to TP, and there will be a discussion on the arm's length price and range, and also there will be a discussion on the TP methods and the 4-step approach and the compliance requirements as well. So let's start on a small introduction to TP. I'm sure most of you must be familiar with this. So the transfer price is the price between two associated enterprises when they transact. And also, what is arm's length price? Arm's length price is the price when associated enterprise transact with a third party, or 2 third parties transact with each other in a comparable situation. So this comparable situation is judged based on different criteria. One would be the characteristics of the products and the functions, assets, and risks, and the contractual terms, and it could be on the strategies as well as the economic conditions. So based on those criteria, the comparable situation would be judged. So if the associated enterprise in this example A transacts with third party Y, it is an internal comparable for this purpose, and the transaction between third party X and Y would be an external comparable. So the reason why transfer price is a big area that is nowadays in the discussion is because there is a potential for profit shifting when the transactions are in between two associated enterprises, especially when it is between when it is an international transaction, or it can be in a domestic situation as well. So to elaborate it further, I have taken this example. So in this example, the parent USA manufacturer, and there is a subsidiary, the UK distributor. So the transfer price is the sales. Parent entity manufactures and sells at 10,000, which is the transfer price for the UK distribute as the cost as well. And from this activity, they have achieved 700 profit and 300 profit respectively. So the consolidated profit is 1,000. And the tax rate applicable is 40% and 10% in USA and UK. So the tax rate applicable in the US is 40%, which means the tax liability is 280 for USA and just 30 for UK. So because there is a difference between the tax rates, there is a vast difference, 40% to 10% between the two countries, there is a potential for profit shifting. In this situation, we can see that the tax liability of the consolidated group is 310, which is 31% effective tax rate. So say, for example, that the USA company wants to shift profit and they would reduce their sales price to 9,600 in this instance. In that case, the profit of the USA company drops to 300, while the profit in the UK company is 700 now. But still, if we look at this, the tax liability is just 190 overall, because the tax rate in UK is less compared to the tax rate in the USA. So the effective tax rate is 19%, which has reduced from 31%. In case if the Inland Revenue Department identifies this, the issue here is there will be a double taxation because the parent in USA company, if the Inland Revenue Department in USA, authority in USA would say 10,000 is the arm's length price, not 9,600. They would charge 10,000 and then they have to pay a tax liability of 280. Which will increase the consolidated tax liability to 350 compared to the previous tax liability, and the global effective tax rate has been increased to 35% now. Let's look at the definition for international transactions in the Inland Revenue Act of Sri Lanka. So based on the Inland Revenue Act, it says either one or more. Either one or both of the entities have transactions with our non-residents, then those transactions can be international transactions. So the nature of these transactions can either be purchases, sales, or services, or lending or borrowing, which can have an impact on the income, gain, or profits, or even assets. So or it can be even services or cost contribution arrangements, anything. So yeah. Also, to brief this more, the Inland Revenue Department also has mentioned that if there is a transaction between two entities other than an associate enterprise, but if there is a prior agreement between these entities are available, then which may have a reduction in the tax payable in Sri Lanka, then those two entities, those transactions between those two entities can also be considered as international transactions. Also, the Inland Revenue Department has identified interest arising from international transactions as well. Let's go to other transactions. So this is where the Inland Revenue Department says, the Act says that the transactions that are other than international transactions will be covered in this section. So domestic transactions will also fall in here. Next section is on the arm's length price and range. So I think I already explained what arm's length price is, arm's length arrangement is. So when it comes to an arm's length price, the arm's length price will be determined using the most appropriate method. So we have five methods for that, which I will be discussing in the slides next. When it comes to the arm's length range, so what happens is if there is a reliable range of prices or margins generated, then the transfer pricing regulation states that the interquartile range, that is the 25th to 75th percentile of that range, is the arm's length range. So in case if the transfer price does not fall within the range, the Inland Revenue Department can consider the median as the arm's length price. First method that we are going to discuss is on the cup method. So this is where you compare the transfer price of the products compared to an uncontrolled price situation in a comparable circumstance. So like I mentioned, the comparable circumstance should be judged based on the 5 criteria mentioned earlier. So in this case, for example, associate enterprise A is transacting with the associate enterprise B at a transfer price of 95 rupees. Whereas we can find a comparable situation where an unrelated third party X transacts with another unrelated third party at a price of 100 for the same comparable circumstance. So then the arm's length price should be 100, not 95. This is the resale price method. So this is where this is applicable when there is a distribution arrangement or a resale price or a price resale margin applicable, and it is applicable only for products, not services. So when, for example, this associate enterprise A is a manufacturer who sells the product to B, the distributor, at a price of 80. And the distributor will incur the cost as well, and the resale margin that is maintained is 10%. Whereas we can find a comparable situation where the unrelated party X, the distributor, is selling to the third party customer by keeping a margin of resale price margin of 10%. Sorry, resale price margin of 5%. So in that case, we need to backward calculate this to identify what would be the arm's length price between A and B if the 5% margin is applied, not 10%. So when we do that, the arm's length price should be 85 and not 80. So this is where you compare the gross profit markup or margin that is maintained by the associated enterprise in their transaction with the third party markup. So in this situation, company A and company B, company A when selling the goods to company B has maintained a GP markup of 10%, whereas a comparable situation, the uncontrolled GP markup is identified as 5%. So then we need to identify what the transfer price, what the arm's length price would be, and it is 105, not 110. TNMM method is very similar to the cost plus method. Instead of comparing the GP markup or margin, it compares the net profit level. So in the same example, I have incorporated the net margin at 10% and the uncontrolled net margin at 5%. So which means the transfer price to be charged should be 105 rather than 110. Okay, so we are coming to profit split method. This is a bit of a tricky method. I'll actually give 1 minute for you to go through this scenario. I suppose everyone had read through. I'll just highlight the key points here. So here, company A, we have taken a company who develops an original microprocessor, who also holds the patent for manufacturing the technology. And company B is an overseas company who is a subsidiary of company A. We take that manufactured microprocessor and we'll develop the mobile phones using that. And company B, after manufacturing the mobile phones, will sell it back to company A to resell it to third parties. So that is the arrangement. So because these kinds of arrangements are very advanced and unique, it is very difficult to locate any comparables with similar intangible assets when there's patents involved. So because of that, traditional methods like cup method, cost plus resale price, or the TNMM cannot be applied in this case. It's difficult to apply. But it was noted that the routine activities performed by these companies, we can identify reliable data for those. For example, contract manufacturers for mobile phones and the wholesale equipment wholesalers. So with that, we can identify that the manufacturers earn a markup of 10% while wholesalers earn 25% margin on sales. This is a simplified accounts that we have developed, company A and company B. This example is taken from the Singapore regulations as well. We have done some adjustments to cater the Sri Lankan requirements. So company A and company B. So this is the situation. Company B sells the product to company A at the end to resell to third parties at a price of 100. And the group profit is 45 rupees. So we have identified that the wholesalers, the comparable wholesalers, will keep a margin of 25%. So if that margin is applied for company A, that would be a 31.25 resale margin. And if the markup that is applied by third-party contract manufacturers is applied to this scenario in company B, that would be the transfer price without intangibles, that is for routine activity, would be 66. So we'll consider the computation without intangibles for the routine contribution. So that would be sales 66, and we can see the operating margin from the routine activities is 17.25 for the whole group. Once you get the 17.25, we know that the overall profit of the group was 45, and now we have identified that the routine profit from routine activities would be 17.25, which means our residual profit is 27.75. So this means that we need to identify a way to divide this profit between company A and company B for their non-operating activities. So in that case, we have identified it can be differed from company to company. In this example itself, we have identified that the value adding the key contributing intangible activities here are the research and development and the marketing expenses. So because of that, we have gotten the R&D expense and marketing expense of each company to see the allocation basis. But the allocation basis determined for each company should be justified to the Inland Revenue Department, as it may differ from situation to situation. So in this case, company A share of residual profit would be 80% into 27.75, which is the residual profit of the group, which will be 22.2, while company B is getting 5.55. So with that, we are adjusting the total operating profits of company A and company B. Company A, the total would be 38.45, company B 6.55. That is the total of the routine profits and the profits after the residual profit segregation. So with that, when we backward calculate it, we can see the sales from company B to company A should be 71.55 and not 100, because it was 100 rupees before. Now it has come down to 71.55, which is the transfer price. Now we will discuss the four-step approach to transfer pricing for local file and the transfer pricing disclosure form requirements in Sri Lanka. So the first step is where you identify and segregate your transactions. So you identify your transactions, you will check the associate enterprise relationship and your transactions, and you segregate it for domestic and international. Once you get the domestic transactions, there are some exclusions that you can do, exemptions that you can do as per the TP regulations. So if there are no exemptions granted, and if the transaction between the two associate enterprises are taxed at the same income tax rate, provided that there are no losses or brought forward losses, then those kind of transactions can be excluded from this analysis. But once you exclude that, you need to aggregate that transactions with the remaining transactions with the international transactions, and that is where you come to this third step, aggregation. So the aggregation step, you aggregate the value of the remaining 8 transactions. If that exceeds 200 million, then there is a local file requirement. If that does not exceed 200 million, then there is no local file requirement and there is no TPDF requirement as well. Once you aggregate, the next step is to determine the requirement for TPDF. So you need to see whether your categories are exceeding 200 million. That would be the fourth step, categorization. So your aggregate value of transactions, you categorize to different categories based on the guidance provided, which we will discuss later. Once you categorize it, if it exceeds, if there's categories exceeding 200 million, then you need to fill all columns from 1 to 4 in the TPDF. And if the categories are less than 200 million, you need to only fill 1 and 2. So in this section, we will describe the associate enterprise definition. As per the Inland Revenue Act, it says that an associate enterprise, a person shall be an associate enterprise of another person if that person participates directly or indirectly through one or more intermediaries in the management, control, or capital. There is also another statement where they are saying that the manner how they would directly or indirectly participate is specified. So this is actually taken from the Indian regulations as well, extracted from India, because however, there is a situation where the first point, that is point A, is decided to be redundant in India because there is a decided case on this. However, in Sri Lanka, the clause is still available, but our view is that point A should be redundant and point B, where the manner how they are associate enterprises are specified in the regulations, that should be taken into consideration. Also, here they have included permanent establishments as well. So let's go to the definition of associated enterprises in the regulations, TP regulations. So there are different criteria. The first criteria is on shares, which carry the majority of the voting power. So if there's persons or enterprises holding directly or indirectly in another enterprise, majority of voting power. So this does not mean that you have to have 50% voting power. It means majority. For example, company, if there's company A who only has around 10% voting power, if the remaining 90% is owned by 90 different shareholders, 1% each, still that company would have the majority of the voting power, although it only has 10%. But when it comes to the point B, it says shares not carrying less than, that is equal or more than 50% of the voting power in each of such enterprise. So, for example, there's company A who owns company B and C, which means that would be around 80% or 70% shareholder in each company. But these company B and C would also be associated enterprises because company A owns each other. The third point is on the board of directors composition. So it says if more than half or even a single or more executive directors or executive members are appointed by the other enterprise, those two enterprises will be associated enterprises. And the next point is where if that situation happens, if that enterprise is appointed by the same person or persons. So it can be by one company to another, or one person or same persons appoint the board of directors to each company. Next point is on loans. So it says that loans advance not less than 51% of the book value of the total assets. However, they have removed loans provided by financial institutions for this purpose. And the next point is on loans and equity, which is the same criteria above, not less than 51%. Again, they have removed loans and equity provided by financial institutions. Next point is on guarantees, not less than 25% total borrowing. So if there's one entity, one enterprise who guarantees not less than 25% of the total borrowings of the other entity, then those two entities will be associated enterprises. So this is another tricky section on the 90% or more scenario. So what happens here is there can be two situations where there is a company who sells raw materials, semi-finished goods, or consumables to company A, and they sell more than 90% of it is taken by this entity for the manufacturing process. So then if that company can influence the price and the conditions relating to that, then those two entities will be associated enterprises. The second situation is where one company purchase goods required for the sales. So if it is a trading activity, again that entity, if it purchase more than 90% or more, then again the same condition will apply. The next point is very similar to that. So the next point is very similar to that, and it says that goods or articles manufactured by one enterprise are sold to another, and the conditions are influenced by such enterprises, and it can be vice versa as well. Those will be associated enterprise. The difference is that here there is no quantification. In the previous point, there was a quantification, but in this point, there's no quantification provided. The next point is on the enterprises who is controlled by an individual jointly by such individual or the relative. So if there is a joint control over entities by an individual or by a relative, or jointly by those individual and the relative, then there can be an associate enterprise relationship between the two entities. This point is to capture associations and partnerships. So if there is a enterprise which is a firm association of person or body of individuals, the other enterprise holds not less than 10% of interest. So we usually think the interest here mentioned here should be the shareholding interest. Then those two entities would be associated enterprises. The last point is where they give the last point is a general point that they have given. So even if there's a situation where there is no direct participation in management, control, or capital, but if there's a potential advantage to enterprises, then those entities also can be deemed as associated enterprises. Let's move to compliance requirements. So we have 6 compliance requirements altogether for transfer pricing in Sri Lanka. First one is a local file, which we highlighted before, and transfer pricing disclosure form, which also we highlighted before, and Schedule 9B, master file, country by country report, and CBCR notification. When it comes to the local file, like I mentioned before, it is required if the aggregate value of any transactions exceeds 200 million, and the local file prepared should be kept available for a period of 6 years. Master file is required if the group turnover exceeds 50 million euros. And the master file usually will provide information on group specific information like MNE's intangibles, business, the organization structures, financial activities, tax positions, etc. Then we have the CBCR and CBCR notification. So CBCR and CBCR notification is required if the MNE has exceeded the turnover of euro 750 million in the preceding financial year. And there's 2 parts here, CBCR and CBCR notification. So the notification should be filed no later than 31st December of the reporting year, and the CBCR should be filed within 12 months after the end of the reporting fiscal year. So just to give an example, so if the company's financial year start is 1st January 2022 and ends in 31st December 2022, then the CBCR notification should be filed for that particular year on 31st December 2022. And the CBCR report should be filed 12 months after the last date of the reporting financial year. So that is on or before 31st December 2023. This is the CBCR template that is given. So yeah, it has basic information about tax jurisdiction and revenues and profit and yeah, tangible, intangible assets, tax jurisdiction, tax rates, and the business activities. So we come to transfer pricing disclosure form now. Like I mentioned before, transfer pricing disclosure form is also required if the aggregate value exceeds 200 million. However, once you categorize it, if your categories are exceeding 200 million, then you must complete all columns, that is column 1 to 4. But if it does not exceed 200 million, then you need to only complete columns 1 and 2. This is the CBCR, this is the transfer pricing disclosure form template given in the regulations. So I'll just go through how to fill this form based on a small example. So using the information provided in the transfer pricing regulations itself. So here they're asking, there's 4 columns. So if your categories are exceeding 200 million, then you need to fill all 4 columns. If it is not exceeding 200 million, only column 1 and 2. So first point is you need to mention the category of transactions. These are the categories provided. So you need to fit your transactions to any of these categories. So it can be a revenue niche category or an expense niche category. There are 52 categories at the moment. So you have to fit your transactions to them. And once you do that, you need to fill your amount of the transaction of that particular category. And if it is a loan, you need to mention the loan amount and then the balance. And in column 2, you have associated enterprise details, and you can put the name and the TIN number. And for the country of residence, the regulations provide country residence codes. So these codes can be used there without typing the whole name of the country. And the next part is to mention about the criteria of associated enterprise. So this is where you mention how these entities are associated enterprises based on the regulations what we discussed earlier. So the number, the association code number needs to be mentioned there. In column 3, we have the TP methodology where you mention the TP method. So what is the TP method applied for the particular transaction? And then we have the profit level indicator. So what is a profit level indicator that you have used to compare your margins or prices? And then you have the tested enterprise. So if your tested party is the Sri Lankan enterprise, then you put 1. If it is a foreign enterprise, you put 2. So column 4 is where you fill your benchmarking details. So if, like I mentioned, if the category is not exceeding 200 million, there's no benchmarking required. So no benchmark details or TP methodology details will be applicable. So we come to Schedule 9B now. So this is also a requirement where Schedule 9B of the income tax return needs to be filled in line with the transfer pricing disclosure form. So when filling that, the transactions with associated enterprises, you need to divide as international and local and put the aggregate values in accordance with the TPDF only. And you can also take the loan value from the TPDF. And if you have any fund transfers that you have declared in the financial statements, if that is applicable, you need to fill your fund transfers as well. So that's it for the session. We will open the session for any questions as well.
Hi, yes, this is Harun. So there are 3 questions already in the questions dialog box. So I've flagged them as well, but if you want, I can read them out to you. Is that okay?
Yes, you can read it.
Okay, so Dinuki is asking, do companies have the freedom to choose which TP method they use? Can the Inland Revenue ask them to change it? So that's the first question from Dinuki.
Okay. So with regard to the most appropriate method, you need to choose what the method that is the most appropriate. So it can be based on different criteria. So you need to compare what are the strengths of one method compared to the other methods. So once you do that, you will get the TP method that you can apply. Yeah, most of the cases, if you have like a third-party transaction that you can compare the price, you would usually go for a cup method, but it depends on the degree of your comparability. If you can compare it 100%, or if you can make adjustments to compare the prices, then you can use that method. But the most common method that the companies are using is the TNMM method. Yes, the transaction net margin method. Profit split method is very uncommon unless there is a unique intangible that is involved. So there are criteria that where you can use certain methods. As far as you can like justify that in your documentation, there is a chance that the Inland Revenue can accept your method.
Okay, thank
yes.
you.
Yes, Hasita, something as well on that.
Something. Hi, I'm Hasita. So yeah, as Karen correctly said, pricing method should be decided by the taxpayer. So as per the law, the burden of proof is initially with the taxpayer. So therefore, they should select the pricing method and prepare the transfer pricing documentation to support the arm's length nature of their transaction. But if tax department is of the view that the pricing method applied is not correct, then the tax department should first reject the basis of preparing the transfer pricing documentation to the taxpayer, and if they can do that, then they can apply any other pricing method if they think that the pricing method applied to the taxpayer is not suitable. Hope that answers your question.
Yes, thank you very much. I think that explains the second part of the question very well, where the Nuki had asked that can the Inland Revenue ask them to change it? So yes, I think you have fairly addressed that part of the question as well. Thank you very much. Moving on to the next question, and this time the question is from Zahra Azam, and Zahra says that she says that I noticed that benchmarks are in euros and not in dollars or Sri Lankan rupee. Any specific reason for this? And if you want further clarification on the question, we can ask Zahra, we can unmute her and ask her to verbally put her question.
Yes, that would be great.
Okay, great. Let me, Zahra, I'm going to open your mic up and you can further elaborate on the question. Your mic is unmuted now, so you can unmute yourself. Sorry, Zahra. I think you are not audible. Janendra, can you confirm if you can hear Zahra?
Not really. It was breaking
up. We can answer.
Yes, we can answer actually. That's all right.
I think.
All right. Okay. Okay. All right.
No, I think when the taxpayer has gone to a database and they have selected comparable transactions or companies for the TP analysis, and I think the figures are in currencies, different currencies. So now it depends on the selection basis and the TP strategy that they have followed. So normally, yes, we in transfer pricing exercise, like we have to select the comparable transactions or comparable companies, right? So ideally, if you are doing benchmark analysis for Sri Lankan transactions, so we need to collect Sri Lankan transactions as comparables, right? So maybe, but there's a problem in Sri Lanka, like there are no comparables in Sri Lanka, publicly available data on Sri Lankan comparables. Therefore, we go to databases and select comparables from other countries. Right? Normally, tax department accept regional comparables. So they are in different currencies. But that's not a major issue. Like if you can prove that the currencies, though the currency is different, that there is no price impact due to that difference, then we can apply that comparable for our analysis. Anyway, though there is currency difference, to determine the comparability, we apply a lot of tests. So if other tests are satisfied, though there is a currency difference, I think taxpayer is in a position to support the arm's length nature through those comparables. So because in our case, like tax department is fully aware that there are no local comparables. Did I hope that answer your question?
Yes, yes. And Zahra has written, I see, that's interesting. So she's understood your answer. Thank you very much for that. The next question is from Irfan Ali, and questions keep coming in. Participants, this is your opportunity to ask more questions as we continue. The next question, it says that when were these disclosure requirements put in place in Sri Lanka? So this is by Irfan Ali.
So transfer pricing regulations was introduced in 2008 onwards, but companies were not very compliant with that. But in 2016, they sent us, they issued new regulations, amendments to state that they need to file a disclosure form with the income tax return, and if the company fails to file that, there would be an issue where the income tax return would be incomplete. So because of that, so from 2016 onwards only, there was a filing requirement for the transfer pricing disclosure forms, but 2008 onwards, the regulations was in place. Hope that answers the question.
Yes, thank you very much. There are still a lot of
Can I add
participants
one
who
more?
are. Sure, yes, please go on. Sorry, I think we are not able to hear anybody. Janindri, I think the camera got switched off.
The department initial strategy was to develop the compliance practice. So with that, in 2016, they asked tax department to file a separate document, actually not one document, 3 documents, along with the income tax return. And also they said like if that is not, those are not filed, the return is incomplete. So basically those were introduced to develop the compliance practice among taxpayers. That's the history. So but still continues.
Okay, thank you very much. I hope the answer was clear. We got disconnected for a little bit, and Asisa, I mean, we just got the last part of your explanation. I hope it was clear to the. But if you can, fairly in a summarized way, if you can repeat the answer. We just got disconnected for a little bit, so if you can repeat that answer.
Yeah. So what I was telling, like, yeah, tax department strategy was to develop the compliance practice among taxpayers. So with that, they introduced 3 compliance requirements actually in 2016. 2016, 1 compliance requirement, and thereafter another 2, if I'm not mistaken, in 2017. So the idea was to develop the compliance practice. So to do that, what they did was like they stated that these documents will be a part of the income tax return. Okay. So that means if the taxpayer fails to file those documents, then the taxpayer's return is incomplete. So they have filed other documents, including income tax return. So that's how they have developed this practice. But now they have removed 2 documentation from 2018. Now taxpayers are required to file only the transfer pricing disclosure form along with the income tax return. It's basically summary form. So taxpayer can prepare transfer pricing disclosure form based on the information in the local file. Is it clear?
Yes, it was. This time it was clear. Thank you very much. The people who were mentioning that, Cesar, you are really soft spoken, so they're finding it a bit difficult to understand. But I think the answer was clear this time. Thank you very much for that. Let's move on to the next question. So the next question is, should the TP method need to be consistent from year on year? And if changed, what is the impact, i.e., is it treated as a change in accounting policy or an estimate? This is Hasnan.
Repeat the last point again.
Okay, I'll repeat the question, the entire question. It says, should the TP method need to be consistent from year on year? And if changed, what is the impact? That is it treated as a change in accounting policy or an estimate?
Okay. So I think you should not mix this transfer pricing issue with accounting issues. So transfer pricing is for tax purposes, not for accounting purposes. So yes, now as we explained, like every year you have to do the transfer pricing documentation, right? So law says like if there's no significant change in the conditions or factors, that taxpayer can use the same documentation for 3-year period, right? But that means like if you prepare transfer pricing documentation in the first year using one pricing method, and the second and third year, if there are no changes, significant changes, taxpayer can use the same strategy, including pricing strategy, to support their pricing in the year 2 and year 3. But if there's a significant change, so then they have to go through the strategy again. So if that strategy shows, if the strategy needs a modification and including the pricing method change, then taxpayer should do that. But the risk is, if the pricing method is changed from one year to another, then tax department, if they identify, they can question. They will, because they know that pricing method can be changed. If there's a significant change, they will definitely look at the changes in the business or whatever, and also they will see whether taxpayer has documented it correctly in the local file. So as I said at the beginning, like this is a tax concept, pricing method and all. It should not be mixed with the accounting concept. It's nothing to do with accounting policy or estimate.
Okay, thank you very much. I think that was clear. Let's move on to the next question, which is from Muhammad Bilal. And Bilal is asking, what is the interquartile range as mentioned in arm length price?
So say you have more than one comparable.
Sorry, Janendra, your voice is gone it's very feeble.
Can you hear me now?
Now, yes, I think there's a loose connection somewhere with your microphone or something. Is it so?
Sorry about that. Yeah. Hope everyone can hear me. So
it's still
what happens is, okay.
Yeah, now it's better. Now it's.
If you have more than one comparable, say that you do a benchmark and you identify six comparable companies, and you compare the margins of those companies. So once you have 6 comparables, you need to arrange it, and then you need to get the interquartile range. So that is from say there's the full range is, say one company has 5% markup and the other company, the last company, has 10% markup. So once you get the interquartile range, that will show the range between 25th percentile to 75th percentile from that 5% to 10%. So that range is the interquartile range, and that range is the arm's length range. So if your price falls within that range, then your transfer price will be considered to be arm's length. Is that clear?
Thank you. All right. So Bilal, if that is clear, please say so in the questions box. But in the meanwhile, let's move on to the next question, which was a continuation of the previous question by Hasnan. And Suleiman is asking, will that change in transfer pricing have a retrospective or prospective impact? This is in relation to the previous discussion.
So now normally we prepare transfer pricing documentation on exposed basis. That means we prepare transfer pricing documentation after the year end. So through that, we try to support the arm's length nature of prices in the previous year, basically, previous year of assessment. So, and also there is no restriction in our regulation. We can do ex ante approach also. That means like when you enter into transaction with associated enterprise, you can do the analysis. So, but in our regulation, like, it's not that clear whether we should follow ex ante or ex post approach. But generally, we have to follow ex post approach, like supporting the arm's length nature of transaction after the year of assessment. So there is no retrospective or prospective effect. So taxpayer is required to support the transaction that they had with associated enterprises. So I think again I should say like it should not be mixed with accounting concept. This is a tax concept. So if you have if you had transaction with associated enterprises in a particular year of assessment, taxpayer is required to support the arm's length nature of the transaction through documentation. That documentation is called local file. So it's not nothing to do with retrospective or prospective effect.
All right, thank you for that. So I think that brings us to the end of the session, because these were all the questions that we had. Participants, if you may have any further question, you can just type it in now, as this is your opportunity to ask any questions. Otherwise, back to the panelists. Okay. All right. Suleiman has extended on to his previous question. He's saying, so as I understand it, it'll impact the current year assessment only.
No, okay. So I think we have two different.
I think he has not understood the point.
Yeah. Now the thing is, say if I take year of assessment 21-22, that means 1st April 2021 to 31st March 2022. Say company had a sale transaction with an associate enterprise. Okay. So now that sale price should be arm's length as per the TP regulation, right? So now, according to accounting standards, the company will record that transaction and in the financial statements, right? But the thing is, for tax purposes, now the sale price should be arm's length. So in other words, like taxpayer should take the arm's length price to calculate their taxable income. Say the sale price recorded in the financial statements is 100, then taxpayer should prepare documentation to support that this price of 100 is correct and it represents the arm's length price. So that's how we do analysis for tax purposes and transparency purposes. But there is no retrospective or prospective thing in transfer pricing. So you are basically supporting the arm's length nature of transaction that already took place. Taken place.
Okay. Yeah, this time he got it. Thank you very much. He's just confirmed. All right. I think that's all, because these are all the questions. I mean, there are a few comments though, and one particular demand is that if the participants can get the slide deck. You know, we have discussed this with Roshni, and it will be shared once EY has permitted that. But in the meanwhile, for those who want to refer to the content of the session once again, I would suggest that the recording of the session is available. So why don't you people go back and have a look at the recording? So I think if you want to review the slides or review the content, the recording, as well as the speeches, the trainers, the content providers, they're all available. So, but you know, in the interest of okay, all right. So, but just as EY approves of sharing the slide deck, these will be shared with you in the shared drive that we've already set up. Okay. All right, Mahvesh. I mean, there's just some comments. Very quickly go through them. There are not any specific questions now. So just some housekeeping questions, so I'll just address them. So for example, Mahvesh is asking, how can we get the previous sessions recordings? So just like in the past, if you've been listening to if you've been a participant of our 6 digits program, we will share the recording links of the previous sessions with you shortly. And Feroz is on the call. I will ask Feroz to take a note of that. and share the recording links with you in a bit. Okay, there are some suggestions, take a screenshot, but I would say this is intellectual property of EY Sri Lanka. Do not try to reproduce the content. We're all, ethical professionals. So therefore, I would say, let's wait for EY to come back and only then try to reproduce the content. Otherwise, please do not, okay? You can listen to the recording, and that's perfectly all right, but do not try to reproduce this content. Okay. All right, Ghulam Fareed is saying that very interactive session. Thank you, thanking to the participants, sorry, the panelists. And so has Tanzeel said, thank you very much, sir. And Mehwish, thank you. So thank you all very much. I think this was an interesting session. The topic, of course, was very, very important, transfer pricing, and very modern. So I'm sure all of you, fully enjoyed or fully made use of the presence of these two experts with us. Thank you very much once again. Is there anything else that you want to add, Janet? Any final words before we close the session?
No.
All right. Okay.
Yes. So let's. We actually want to highlight on the penalties as well that we haven't mentioned in the slides. So Hasita will mention you on the penalties. That would be the point.
Just small thing like I think in the past taxpayers didn't follow the transparency compliance requirement, but as per the Inland Revenue Act, there are like if taxpayers fail to comply with transparency regulation, then there are penalties that are very high. And also, the tax authority has built up their expertise and resources. So with that, I think that they have already started. They will do a lot of audits in the coming months and years. So taxpayers, I think, if they have not complied with it now, they should at least start now. So will follow a very aggressive approach now onward, because they have given some time to taxpayers. I mean, they have not officially given, but they initially wanted to develop the TP practice among taxpayers. But now I think they want to start audits, and if they don't comply, they will definitely try to charge the maximum tax and also penalty. So that's the message I want to give. As last one.
Okay, all right, thank you very much. I think this was an important message for all professionals, particularly the ones based in Sri Lanka, that the regulator is coming strict on these regulations. And so I think good time that you're trying to develop these skills, and compliance is a must. So there are no two ways about it. It has to be done. So just get ready. Get ready for a full-fledged compliance and implementation of these. All right, thank you very much once again, panelists. The participants are all very thankful for your sharing of experience and knowledge. I think with that, we call it a day. Thank you very much, all of you, for taking time out, particularly the participants from Sri Lanka. Thank you for your time, and we look forward to our next session next week on Tuesday. Thank you very much. And yes, you're right, Tanzeel, stay healthy and stay safe. Thanks a lot.
Thank you. Thank you.
Thank you.
Thank you.